The world of real estate investing holds a promise that few other paths can match. While your friends are watching their savings accounts barely keep up with inflation, real estate investors are building wealth that compounds year after year. Properties appreciate in value, rental income flows in monthly, and tax benefits provide additional advantages that most people never even consider. But here's the truth that nobody talks about enough. Real estate investing isn't reserved for the wealthy or the well-connected. Everyday people are stepping into this space and transforming their financial futures, one property at a time. The beauty of real estate lies in its tangible nature. Unlike stocks that exist only on a screen, properties are physical assets you can see, touch, and improve. They provide shelter, create communities, and generate income while you sleep. The question isn't whether real estate investing works. Millions of investors have already proven that it does. The real question is how you can get started, especially when you're beginning from scratch. Understanding your investment options, real estate offers multiple pathways to building wealth, and choosing the right one depends on your financial situation, time availability, and personal goals. Rental properties remain one of the most popular strategies for beginners. This approach involves purchasing a property and renting it to tenants on a long-term basis. The monthly rent payments cover your mortgage, property taxes, insurance, and maintenance costs while ideally generating positive cash flow. Over time, the property appreciates in value, and your tenants essentially pay down your mortgage for you. The combination of steady income, equity buildup, and appreciation makes rental properties a powerful wealth-building tool. House flipping represents a more active investment strategy. Flippers purchase undervalued properties, renovate them quickly and efficiently, then sell for a profit. This method can generate substantial returns in a short period, but it requires significant knowledge of construction costs, market values, and project management. The risks are higher because you're betting on your ability to accurately estimate renovation expenses and sell at the right price point. For those willing to learn the ropes and manage the intensive process, flipping can produce impressive profits. Real estate investment trusts offer a hands-off alternative for those who want exposure to real estate without the responsibilities of direct ownership. These publicly traded companies own and operate large-scale properties like apartment complexes, shopping centers, and office buildings. When you invest in a trust, you're essentially buying shares in a diversified portfolio of properties. The company distributes profits to shareholders as dividends, providing regular income without the headaches of property management. While returns may not match those of direct ownership, this approach offers liquidity and simplicity that appeal to many investors. House hacking provides an ingenious entry point for first-time investors. This strategy involves purchasing a multi-unit property, living in one unit, and renting out the others. The rental income from your tenants covers most or all of your housing costs, allowing you to live nearly rent-free while building equity. It's particularly attractive for beginners because you can secure favorable financing terms on your primary residence while learning the fundamentals of property management. Many successful investors started their journeys through house hacking before expanding into larger portfolios. Preparing your finances forms the foundation of successful real estate investing. Before you start searching for properties, you need to assess your current financial situation honestly. Most lenders prefer to see credit scores of at least 650, though higher scores unlock better interest rates and terms. If your credit needs improvement, focus on making payments on time, reducing your credit utilization ratio, and addressing any errors on your credit report. This preparation period isn't wasted time. It's building the financial credibility that will serve your investing career for decades. Your debt-to-income ratio matters just as much as your credit score. Lenders calculate this by dividing your monthly debt payments by your gross monthly income. A lower ratio demonstrates that you have sufficient income to handle additional debt responsibly. Pay down existing debts when possible, and avoid taking on new obligations while preparing to invest. Create a dedicated savings account for your real estate fund, and contribute to it consistently. Even small amounts add up over time. And the discipline of regular saving builds the financial habits that separate successful investors from dreamers. Down payment requirements vary depending on your chosen strategy and financing method. Primary residences typically require as little as 3 to 5% down, while investment properties often demand 20 to 30%. Government-backed programs like those from the Federal Housing Administration offer down payments as low as 3.5% for qualified buyers. Some lenders provide specialized programs with even lower requirements, particularly for first-time buyers. Research the options available in your area, and don't assume you need 20% saved before you can start. Many successful investors began with much less. Researching markets and properties, market research separates profitable investments from costly mistakes. Start by analyzing your local area, but don't limit yourself to what you already know. Look for markets with strong job growth, population increases, and diverse economies. These indicators suggest a stable demand for housing, which translates to stable rental income and property appreciation. Study neighborhood trends, crime statistics, school ratings, and infrastructure developments. Properties near new employers, transportation hubs, or planned improvements often appreciate faster than average. Running the numbers accurately determines whether a property makes financial sense. Calculate potential rental income by researching comparable properties in the area. Subtract all expenses, including mortgage payments, property taxes, insurance, maintenance reserves, vacancy allowances, and property management fees if you plan to hire help. The remaining amount represents your cash flow. Positive cash flow means the property generates income after all expenses. Some investors accept minimal cash flow in markets with strong appreciation potential, while others prioritize monthly income. Neither approach is wrong, but you need to understand what you're choosing and why. The 1% rule provides a quick screening tool for rental properties. This guideline suggests that monthly rent should equal at least 1% of the purchase price. A property costing $200,000 should generate at least $2,000 in monthly rent to be worth considering. While this rule has limitations and doesn't work in all markets, it helps you quickly eliminate properties that won't cash flow. Use it as a starting point, then dig deeper into properties that pass this initial test. Building your investment team. Real estate investing is fundamentally a team sport. Trying to do everything yourself leads to mistakes, delays, and missed opportunities. Start by finding an experienced real estate agent who understands investment properties. They should know how to analyze cash flow, understand rental markets, and have access to off-market deals. A great agent becomes a trusted partner who brings opportunities to you before they hit the open market. A mortgage broker expands your financing options beyond what any single lender offers. They work with multiple banks and lending institutions, shopping your loan application to find the best rates and terms. This service costs you nothing because lenders pay the broker's commission. The time saved and potentially better terms you secure make this relationship invaluable. Find someone who specializes in investment property loans and understands creative financing strategies. Property managers handle the day-to-day operations of your rentals, from finding tenants to coordinating repairs. While they charge a percentage of monthly rent, usually 8 to 10%, they free up your time and provide professional expertise, even if you plan to self-manage initially. Building relationships with property managers gives you the option to scale your portfolio without being overwhelmed by management duties. Interview several companies, check references, and understand their processes before signing any agreements. Taking action and scaling. The gap between knowledge and action stops more potential investors than any other obstacle. You can study real estate for years, but wealth builds only when you actually purchase properties. Start small if necessary. Your first investment doesn't need to be perfect. It needs to be good enough to get you in the game and provide the learning experience that books and courses cannot replicate. Every successful investor made mistakes along the way. The key is making them while the stakes are manageable and learning from each experience. Once you complete your first deal, the compounding effect of real estate investing becomes apparent. The equity in your first property can fund the down payment on your second. Rental income from multiple properties creates a snowball effect, allowing you to acquire additional assets faster. Some investors use refinancing strategies to pull equity from appreciated properties without selling, then deploy that capital into new acquisitions. This approach, often called the method of buy, renovate, rent, refinance, and repeat, has helped countless investors build substantial portfolios. Real estate investing offers a proven path to financial independence, but it requires commitment, education, and action. The strategies outlined here work for beginners who are willing to do the work and make smart decisions. Your financial future doesn't have to depend solely on a traditional job or unpredictable stock markets. Properties provide tangible assets that generate income, appreciate over time, and offer tax advantages that amplify your returns. The best time to start was yesterday, but the second best time is right now. Take the first step, educate yourself continuously, and build the real estate portfolio that transforms your financial life.